Hi everyone, I'm Robert Luft, Portfolio Manager with Luft Financial. In today's video topic, we would like to spend some time discussing retirement income strategies that are going to help you reduce the risk of emotionally changing your investment policy, i.e. moving from, say, a balanced portfolio or balanced growth portfolio to cash, and help you find ways to weather longer periods of macroeconomic stressors that neither yourself nor us can control, while still helping you maintain a retirement income. So for people, once they reach that retirement distribution point of their life, they're starting to draw out money, it's critical to manage your emotions during periods of market volatility. So it's difficult to do so, though, if you're worried about running out of money in retirement and you don't have a defined benefit pension income. So this can create a lot of emotional stress. So what we need is a plan for keeping you invested, not running out of money, and still paying you a regular stream of income. So in today's video, what we want to show you is an approach that we're using to create a plan to manage volatility with a number of simple questions. Number one, how much can I withdraw from my portfolio? Number two, how do I withdraw from my portfolio during longer periods of uncertainty and still not run out of money? Number three, how do I build in a measure of cash protection while, number four, still maintaining a growth bucket? So we're going to revisit this cash wedge strategy and how we can implement it in retirement and allow you to have a portfolio and an investment policy for a growth bucket. Recent research shows that retirees can begin drawing down income from their portfolios at a rate of approximately 4% from a withdrawal rate perspective. Now, this assumes a 90% probability of still having funds remaining after a 30-year time horizon. The problem is 4% is not enough for a lot of people. This annual withdrawal rate would have been adjusted for inflation and based on inflation in the previous year. So from Morningstar, this was their study, The State of Retirement Income 2023 by authors Christine Benz and John Reckenthaler. But what this really means is that a 60-year-old couple who wants income until they're 90 would take per 100,000 of investable assets, only $4,000 per year. So that means a $500,000 portfolio would only have $20,000 in annual withdrawals. So what if the same couple really wanted 6.5% on their $500,000 portfolio? So that would be $32,000 per year, $32,500, so $2,708 a month. So research shows that that portfolio would be spent in 15 years, so twice as fast. So how can we meet your withdrawal rate expectations and still not have you run out of money? So how do I withdraw from my portfolio during periods of market uncertainty and not run out of money, especially given the sequence of returns? In other words, what happens if I get bad returns right off the hopper when I retire? So a balanced growth portfolio that holds 60% stocks and 40% bonds dropped significantly from 2008, mid-2009. It took 3 years from the beginning of that downturn to recover the values of the balanced portfolio. Now, that assumes that you weren't taking income. So what about our example of this couple that wanted $32,000 a year, $2,700 a month in income in retirement? Their $500,000 portfolio would have dropped to $300,000 by 2009. So what do you think most people did at that time, faced with 25 or more years of retirement income needs and a portfolio that was $200,000 less than when they started a year and a half earlier? Correct. Emotions took over, and many people, a lot of people, changed their strategy. So they either went to cash and they locked in losses, never to recover, never to return to the capital markets, and they spent less in their retirement, or they blamed somebody else for the drop. And they expected a different result with the same level of risk tolerance using this same allocation to equities of 60-40. So in option A, going to cash, you would have had to reduce your withdrawals to $1,000 a month to have the funds last, because you only had $300,000 left. In option B, you would have run out of money by now if you just simply moved to a different 60-40 portfolio. So you'd have under $100,000 left, assuming 16 years later. So you'd be 76. So what was the real problem? They couldn't go to cash, and it wasn't the portfolio manager's fault that they were in a 60-40 portfolio right when the world dropped. It was unlucky timing. So think about this. You can't predict or control the future. You can only plan for it by understanding the potential risks that have occurred in the past. And one of the biggest risks you face during retirement is sequence of returns. In other words, that the capital markets are falling right at the period of time when you are retiring. So, as we've discussed many times, during periods of market volatility and market downturns, fear takes over and rational financial planning goes out the window. We see this all the time. Chasing returns on the upside and irrationally changing strategy during periods of downturns. In either case, the predictably irrational investor rarely, if ever, takes responsibility for what's happened. The fact is, if you're a balanced growth investor and your portfolio is going to have 60% allocation to equity markets, to good quality stocks, and 40% of your portfolio is income-based, if stocks drop 40%, you're going to drop 25% or more in a year. So what happens if global stocks drop 35%, 45%, like 2008? A balanced portfolio is going to drop 24% no matter who's managing your money. So asset allocation, how much you have in the market, drives that variability. So over the past 16 years, to get this average 4.5% to 5% return as a balanced growth investor, you must be willing to accept annual fluctuations as much as a 25% gain or a 25% loss in any given year. This is fine if you aren't spending the money during retirement, but how do you protect yourself from that if you have unlucky retirement timing? In other words, the retirees in the example of somebody who retired in 2008 might never recover from that bad hit up front, even if they maintain their asset mix. So taking $32,500 from the portfolio in 2009 meant that at that point, they weren't withdrawing 5% or 6% of their portfolio, they were drawing 8.5% of that original $500,000 portfolio. They would have had to reduce their withdrawals and face the fact that they were going to run out of money, or reduce them significantly if they didn't want to run out of money in 12 to 15 years. This is where our cash and harvest bucket strategy comes into play. So at retirement, all of us are very concerned about world events we have no control over derailing our retirement strategy. This may cause us emotionally to change our strategy, move everything to cash or a GIC, and massively impact our long-term returns. But how do we reduce the risk of a negative global event impacting our portfolio and our retirement income up front? So say we look at the investor with a $500,000 portfolio who wants $25,000 in annual withdrawals. They could keep 30% of their portfolio, or in this example, anywhere up to $150,000 in a portfolio that includes things like high interest savings, mortgages, and bonds. Call this the cash wedge. The remaining 70% of their portfolio could then be invested for growth with a time horizon of over 5 years. We would not harvest from this growth portfolio until such time as it makes a positive return. So in years of a positive return on the growth portfolio, you would take those positive returns and move them to the income generating portfolio. Let's go back to our clients with a $500,000 long-term investment portfolio. We would keep $375,000, or approximately 75% of their overall investment portfolio, invested in growth investments. So this would be potentially 80% of the portfolio would be equity-based. In this case, this could mean their entire TFSA portfolios, which were 200,000, one of the RSPs, which was 150,000, and 25,000 of the other RSP. In any year where that 375,000 generated a positive return, we would move it to what we would call an income or cash bucket. This would be one of the RSPs moved to a RIF with 125,000 in it. Now recall that the clients wanted 25,000 a year out of their overall $500,000 portfolio. That's a 5% withdrawal rate. So keeping 125,000 in this cash bucket invested in things like bonds, mortgages, and high interest savings would allow us to effectively keep 5 years of income of their overall portfolio outside of the equity markets. So those cash flows, 5% of the total, the clients would take out $2,083 a month from this RIF. Another way to look at it is it's like a winery. You've hired somebody to look after the winery. That would be us. We would be your vineyard managers and winemakers. Now what we're going to do is we're going to tend to those grapes. Whenever those grapes have a plentiful harvest, we're going to harvest some of those grapes and we're going to turn them into wine. Now normally you may just drink that wine on a regular basis. In this case, what we're going to do is we're going to cellar some of it. That's the cash bucket. That way we can ensure that the $2,083 a month that's coming out, the 5% of the overall portfolio that you are drinking, is always available in this income portfolio. There will be times that it won't matter how well we're tending to the vines. There'll be weather, there'll be bugs, there might be bad soil, there could be a fire. In those years, we're always going to have 25% or potentially more if you choose of the portfolio there, 5 years of cash flow already in the cellar that you can take and utilize on a regular basis for your retirement income. Oh, how often does this work? When might it not work? What if we started at the worst possible points in time historically? So 2000 to 2003, 2008. In 2000 to 2003, a portfolio with this allocation would have lasted 16 years at a 6.5% withdrawal rate. So it wouldn't recover if we were taking 6.5%. From the problem being the 3 consecutive drops initially when the clients retired. What about 2008? You have a big drop up front. The portfolio drops 24.5%. So it would still be worth $225,000 today, but it wouldn't last 30 years. So how do you protect against any chance of this strategy not working, even if you had the worst timing? Well, the examples I'm showing you here are based on what we see a lot, which is people taking a 6.5% withdrawal rate. So the key is a 5% withdrawal rate. Now, if you remember the study at the beginning of this video, they were recommending with 90% certainty to have your money last 30 years, you could only take a 4% withdrawal rate. We see that 6 is too much. So this is like the Goldilocks portfolio. Not too hot, not too cold, just right. Just right, let's try a 5% withdrawal rate. What does that mean? It means somebody starting with a $500,000 portfolio, getting to retirement and asking us the question, how much can I take? A realistic answer would be 5% of your total portfolio. So $25,000 a year. So that means to get you a $50,000 annual income in retirement, you need to accumulate $1 million worth of capital. What we can do is keep 75% of your portfolio at that point, however, in an investment for growth, a growth portfolio, 75% equities. 25% of the portfolio, which would be your 5% withdrawal rate, 5 years of that, could be allocated to a cash bucket holding high interest savings, mortgages, bonds, and other cash producing investments. You would take 5% of the total portfolio. So in this case, 500,000, you take 25,000 a year from the cash wedge. When the harvest portfolio exceeds 350,000, which is 70% of the original capital that the clients had invested of 500,000, you would take the gains, harvest the gains, and move them from the growth portfolio to your income portfolio. So if I go from 350 to 375. I move 25,000 at the end of the year from my growth portfolio to my cash portfolio. And I can do this semi-annually. I can do this once a year. What this ensures is that whenever there are gains on the growth side of my portfolio, I'm harvesting those gains, putting them into a lower risk environment that I can derive a regular income from. Essentially, then, there are 5 key questions that every financial plan should answer. How much do you have in your long-term portfolios? In what kind of buckets, in other words, account types, are you holding it now? How long until you need to start withdrawing funds from your buckets? And how much are you going to add per year or per month until you actually start withdrawing those funds? And then how much do you need every month after tax when you actually do stop working? So those should be the 5 questions at the beginning of your financial plan that you're building with our team. So if you think about it, if you're over 5 years until you start withdrawing money, your goal is still accumulation. You don't need income. So you could put 100% of your portfolio into a bucket that's at least 80% equities. You don't need to have the cash bucket. What if I'm 5 years to retirement and I'm still accumulating assets in that next 5-year period? Well, I'm still in the accumulation stage, but within 5 years, I need to generate income. So what I would do is I'd keep 100% of my portfolio still in the growth or harvest bucket, but I'd add all of my new funds to accumulate in the cash bucket to build up that 30% I need by the time I retire. And then once I'm in retirement, I'm no longer in accumulation. I'm decumulating. I require income from the portfolio. So at that point, I change my allocation. I ensure my allocation is 70% or more to the harvest bucket and the remainder in the cash bucket. That gives me 30% in the cash bucket, 70% in the growth bucket, and I take my 5% of my overall portfolio from the cash bucket. And remember, in any year where my harvest allocation bucket is positive, I take the returns and I move them into my cash or income portfolio. How do you implement this with your own personal financial plan? Meet with your advisor, go over those 5 key questions, set up your harvest and cash buckets if you're in the decumulation phase. And once you've got these established, you'll find that your emotional capacity to deal with whatever the future holds will be greatly increased and you'll probably sleep better at night. Hopefully you found this video educational, and if you've got any questions, please reach out to a member of the team.